Unfortunately, we will not be able to bring you the rest of Market Watch today. But of course, let's have our first conversation today. The interest rate spread, which is the gap between lending and deposit rates, has been a persistent issue in Nigeria's banking sector since liberalization. Compared to regional and global benchmarks, Nigeria's widespread suggests systemic inefficiencies and economic distortions as regulatory policies and tight monetary conditions further exacerbate the situation. Consequently, interest rate spreads in Nigerian banks have surged from 6% to a record 19% between 2023 and 2025, raising concerns about their impact on economic growth, financial inclusion, and investment. Joining me for more on this, I have Tilewa Adebajo, the CEO, CFG Advisory. Thank you so much for joining me today, sir.
Good morning.
Good morning to you too. I want us to begin by determining what a high interest rate spread really means.
Well, I think you've captured it in your introduction, which was clearly an extract from the report that we wrote on the adverse effects of adverse effect of high interest rate spreads on the Nigerian economy. As you know, banks make money by lending on the spreads between their deposits and their lending rates. And it is these rates that determine, interest rates. And the benchmark, of course, as we know, is the monetary policy, is the MPR. So basically, what is important for the banks are the spreads. Even if the interest rates is lower, if the spreads are high, it can still be detrimental. So you can still have interest rates at 20% and have higher spreads, which will invariably impact on the economy negatively. So these are the issues that we need to address accordingly.
All right, so at what point do we say the spread is actually high? Is there a percentage we need to work with? Is it 1%, is it 2%, or when does it become, high actually?
Well, it depends on the environment we're in, but I think what you have seen, I don't know if you have the graph, is that what we did was we benchmarked interest rate spreads over the last 15 years with Nigeria, Africa, and G20 countries. And we found out that persistently, interest rate spreads in Nigeria have been higher than those two other countries we benchmarked it against. And we find out that Nigeria probably has one of the highest interest rate spreads in the world.
All right, so I like how that you benchmarked this with, regional and global banking institutions, but I don't know if you have an analysis that sort of paints the prevailing macroeconomic and fiscal condition of these other economies. Maybe that will help us understand, this better. Maybe there is a reason Nigeria's is really very high and theirs is lower. Maybe we'll do a comparison, like I said, of the macroeconomic conditions and the fiscal condition.
Well, there are several factors I think we've gone into that cause the CRR to be high. That one of the key factors that influences interest rate spreads is CRR. I've seen something on your screen which talks about the profit margin a bank makes on lending activities. I think we need to be very careful in that because we didn't say that. Profit margin, I think you need to qualify that second statement. When you talk about profit margin on lending, it goes beyond that. So I think you need to qualify that second paragraph. When talking about it, which represents profit margin a bank makes on its lending activities. No, that's not true. I think you need to be very careful. There are many other calculations that come into profit margin. So that's just something that I want to clarify before we move on. And, this is not attributable to us. But having said that, I think what tends to happen is that there are factors in Nigeria that cause interest rate spreads to be high. First amongst them is CRR. Second amongst them are all the AMCON levies, NDIC tax, and now withholding tax we have in our system. Then, of course, operational costs in banks. Nigeria's banks are also not immune to the infrastructure costs within the Nigerian economy. And, of course, banks are not immune to the high cost of transport, which has resulted from the fuel increases. And I think these are the things we've looked at. But we have to understand also that there is a reason why the CRR is where it is today. And I think we need to make that clear distinction. In any economy, I think as with other global economies, which you see, we need to strike a balance. And you ask me, why is it different with other parts of the world? In the United States, for instance, you know that post-COVID, there was inflationary pressures on America, and inflation in America went as high as about 9%. So what the Federal Reserve Bank did in America was to take a policy on increasing interest rates to be able to bring down inflation, which is what you call an orthodox policy approach. So what the Federal Reserve Bank did in the States was to increase interest rates, and over a period of 2 years, those rate increases resulted in lowering the rate of inflation to under 3%, which now prompted the Federal Reserve to begin to cut its rates to be able to, since it was close to reaching its inflationary targets. So that is a standard classical approach. But unfortunately, in Nigeria, we do not get things right. So it causes a lot of distortions in our economy. And that is really where we have the problem. If we can follow a standard orthodox policy whereby we increase our rates and then we gradually bring down inflation and then we stabilize the economy, then we wouldn't have too much of a problem. But in the Nigerian economy, there seems to be too many shocks in the system. And I think this is what is causing the problem.
Absolutely, and just like you have already said, some of these factors are regulatory, and we understand that these measures were taken by the Monetary Policy Committee to tame inflation. And do you think that the Monetary Policy was left with any other option in its quiver? Is there any other thing the Monetary Policy Committee could have done to address inflation? Because at the end of the day, these monetary policy tools that were sort of put in place is what is also largely responsible for the spread we're seeing.
No, that's not true. You have to understand, people make a mistake as to understand what monetary policy is. Monetary policy does not react to the situation it finds itself in the economy. If inflation is low, then nobody wants inflation in any economy because inflation consistently has destroyed economies. So in a situation where you have high inflation, you will expect rates to be high to be able to tame inflation.
Okay, so since
at the point in time when interest rates were low, where inflation was low in Nigeria, and then monetary policy is low. So monetary policy only reacts to what it has in its environment in order to be able to control and retain economic stability.
All right, that's the point we're all trying to make, because to start with, there was something that necessitated, the monetary policy to use some of those tools. Whether you want to talk about the CRR, or you want to talk about the liquidity ratio, or you want to talk about the MPR in itself. And when we are talking about this spread, these are the things or the indicators that we are looking at. So at the end of the day, that's why I'm asking you, is there something that could have been done to actually avoid, the situation we are in now, saying that there is the elephant in the room, which is inflation, and there is the forex, instability that the MPC, or let's say the CBN, is actually trying to target and fight and ensure that we are in a good place?
Yes, I mean, it's very clear as to what caused this cycle of inflation. What caused this cycle of inflation is 35 trillion in ways and means spending. I mean, it's very clear. If you go back to about about 3-4 years ago, inflation was coming down to 11%. But then all of a sudden, ways and means spending went all the way up to 23%. And before we knew what was happening, ways and means was at 35 trillion. Not to talk about the fact that ways and means financing is illegal, but by the time you do ways and means financing to the tune of 35 trillion, of course it's going to impact on your money supply, and then it's going to impact on the inflation. Then to exacerbate these matters, you've increased the fuel prices. You know what the fuel prices used to be before. So now fuel prices are now going between 950 to 1,050, depending on where you buy the fuel. And fuel price increase, as you know, has a direct impact on cost boost inflation, because with fuel price increases, it increases the price for transportation, increases the prices for logistics, and that impacts food prices and all other areas. So you can begin to see that those were the policies that led to the high inflationary environment which we were. So what is important is the fact that government needs to coordinate their policy implementation. And, the coordination of both monetary policy, fiscal policy, trade policy, investment policy, and it's all very important. And if you do not coordinate this, you're going to have the distortions. So the reforms that were being planned or that have taken place has impacted not only inflation, but has also impacted exchange rates. So the monetary policy authorities have responded accordingly. So we now have to look at time to be able to bring this down, which is why I gave you the example of what the Federal Reserve Bank did in the United States. Post-COVID inflation, it took them 2 years to be able to bring down inflation to acceptable levels. And that is the same thing that we're going to have to do in Nigeria on a consistent basis.
Right. So away from that, you mentioned that, unusually widespread in comparison to regional and global banking institutions suggest there are intrinsic and systemic inefficiencies within the Nigerian banking system. Now, that's according to the report that emanated from you. I'd like you to help us shed more light on that, talking about the inefficiencies and intrinsic, issues you mentioned.
Yes. In most countries, you understand CRR is not this high. So don't understand what happens with a high CRR regime, the fact that there are high operational costs within the system, there's an inflationary impact on the system, and now you find out that government is also spending, government spending and financing the government deficits. The government deficit for this year in the budget is now 16 trillion. Government debt has now gone up to 150 trillion, and all this money is being financed by the Nigerian capital markets. So government is crowding out the private sector. So when you have this situation, it's unfortunate that you have 50% CRR to be able to tame inflation, but the 50% funds that are also still left available, government is now competing with private sector and crowding out the private sector to borrow this money. So these are some of the imbalances that we have in our economy. And the fact that we have not been able, in the last 8 years, we have not really been able to achieve any form of economic stability. And the fact that inflation is in stagflation, there's growth is limited. Nigeria's economy has only been growing on average about 2.5% over the last 8 years, which is not acceptable for a country that has a population of 200 million people. We expect at least between 8 to 10% growth, double-digit growth on a sustainable basis. And you can see the impact on our GDP that has dropped from almost 700 billion to just under 200 billion, in the last 5 years. So these are the challenges in this environment that invariably impacts the financial system. So what we're saying is that there's need for economic stability, because if you do not have economic stability, you're going to impact lending. And if you impact lending and the banks cannot lend to the real sector, then you cannot drive growth in the economy. So there are all kinds of factors that are combining to make these things a challenge. And that is where government needs to address a coordinated economic policy approach.
I say you've almost answered all my questions anyway, but of course we have just about 2 to 3 minutes to wrap up. I just want to ask you this one. What complementary action, could the banks, fiscal authority, or regulators have taken to sort of cushion this impact that we are seeing? Because I see you've already talked about the impact of this spread in the economy.
Well, first of all, let us understand that Nigeria's economy is a dynamic one, okay? And the potential for this economy is what we're suffering, which is the output gap. Output gap is the fact that we have our productive potential and our current potential. Because of low productivity, we have an output gap. We're not producing to our potential. So maybe you can look at under capacity or low capacity outputs within the economy. Having said that, I think what is important is that let us remember there was a time that this economy was growing between 8 to 10% and almost at a point in time, almost as high as 15%. So it's not as if we have not done it before. In those times when the Nigerian economy was growing at that rate, we had inflation at even 11%, 10%, and there was not a problem. So what is important is that we need to put policies in place to move back in that direction and to be able to have a balanced approach to economy and create an environment that will be enabling growth and enabling development and enabling what you will call sustainable growth. And what we've said over the years is that the government needs to sell down on its assets. The government's current assets is, the current liabilities are greater than the current assets. So there's insolvency. So we need to sell down assets. We need to inject equity into the government's capital structure. So government needs to sell down some of its JV assets, raise between $30 to $50 billion and use it to restructure its balance sheet and restore economic stability.
All right, thank you so much, sir, for coming on the show and for sharing your thoughts with us. Tilewa Adebajo, CEO, CFG Advisory. Thank you so much for coming and do enjoy the rest of the day.